You've been making mortgage payments for years. That means that you've been building up equity. Here's what you can actually do with it. When you have significant equity in your home, you have choices. The mistake is assuming that your bank will actually walk you through them. One option that you have is a refinance. If you're carrying high interest debt that's eating your cash flow every month, or you have a renovation you need to fund, or your kid is trying to get into the market and needs help with a down payment, a refinance lets you access the equity you've built up as cash at a mortgage rate, not a credit card rate. Another option you have is a HELOC, a home equity line of credit. You're going to need money over the next few years, a renovation that's happening in stages, for example, but you don't want to pull it out all at day one and start paying interest on money you're not using yet. A HELOC sits alongside your mortgage. You draw on it when you need it and pay it back on your own schedule. And another option is a second mortgage. If you locked into a great rate on your first mortgage and rates have since gone up, breaking the mortgage to access equity is expensive. A second mortgage sits behind your first and leaves it untouched. It's a higher rate than your first mortgage, but sometimes that's the right trade-off. And these don't have to be either or. On several files I've worked on recently, we've consolidated debt into a refinance mortgage and added a HELOC at the same time, cleaning up the high interest debt now, but having flexibility to draw on equity later without starting over. The right answer depends on what you're trying to accomplish. Not sure which option fits your situation? Connect with me, 249-480-1249.